This is what always happens before a market crash. On one hand, most Wall Street analysts remain bullish, and it feels like this bull market can keep going for much longer, and that everything is still fine. But on the other hand, we are starting to see several warning signs appear. These are the same signals that show up before almost every major crash in history, whether it was before the Great Depression in 1929, the dot-com bubble in 2000, or the global financial crisis in 2008. In this video, I will walk you through the patterns that always come before a market crash. Then I will show you how smart investors prepare their portfolios before a crash happens. Let's not waste any time and let's jump straight into the first indicator, valuation. One of the earliest recorded examples of a valuation bubble was the tulip mania in the 1600s. At the peak in 1637, a single tulip bubble in the Netherlands was reportedly selling for more than 10 times the annual income of a skilled worker, and in some cases, close to the price of a house. Many buyers never intended to grow or use the tulips at all. They were only betting that someone else would pay more the next day. But then, in February 1637, when buyers suddenly failed to show up at an auction, fear and panic spread quickly, and prices collapsed overnight, wiping out fortunes in a matter of days. The same pattern appeared again during the Great Crash of 1929. In the years leading up to the collapse, stock prices rose much faster than corporate profits. The cyclically adjusted price-to-earnings ratio, or CAPE ratio, climbed to about 31, nearly double its long-term average. At the same time, the real economy was already weakening. US industrial production peaked in June 1929 and began to slow even before the market turned. And when confidence finally broke, the Dow Jones Industrial Average fell by nearly 90% over the next 3 years. A similar pattern played out in the dot-com era. In the late 1990s, internet companies were valued not on profits, but on web traffic and big future stories. Many firms had little to no revenue while burning massive amounts of cash. One well-known example was Pets.com, which went through more than $300 million of investors' money and generated just $619,000 in revenue in its final quarter before shutting down. During that period, the Nasdaq Composite has surged by almost 600% from 1995 to 2000, while the Shiller CAPE ratio reached 44, which was the highest level ever recorded at that time. When earnings failed to justify those expectations, reality caught up and the Nasdaq eventually collapsed by about 78%, and thousands of companies went to zero. The same story repeated during the 2008 financial crisis, where valuation once again ran ahead of fundamentals, but this time through housing and financial assets. From 1997 to 2006, US home prices nearly doubled, while household incomes rose far more slowly. At the same time, banks were packaging risky mortgages into complex securities that were treated as safe. By 2006, subprime mortgages made up about 20% of all new mortgage originations, up from less than 10% in the late 1990s. While the stock market did not look as extreme as in 2000, asset prices across housing, credit and equities were built on the assumptions that defaults would stay low and prices would keep rising. But when those assumptions failed, the global financial system collapsed. Today, the Shiller CAPE ratio is once again near 40, higher than before 2008 and second only to the dot-com peak. Beyond the CAPE ratio, investors also look at the Buffett indicator, which compares the total value of the stock market to the US GDP. In simple terms, it measures how large the stock market is compared to the size of the real economy. Historically, this ratio has averaged around 80% to 100%. Before the dot-com crash, it peaked near 140%. Before the 2008 crisis, it was slightly above 100%. But today, it is above 200%, meaning the US stock market is currently worth more than twice the size of the entire US economy, and the highest level ever recorded. Speaking of valuation, one quick and easy way to tell whether a company is cheap or expensive is by checking its PE ratio. On the moomoo app, if you open a stock and go to the company tab under company valuation, you will see the stock's current PE, how it compares with its own range over the past 5 years, and its forward PE based on future expected earnings. This gives you both a backward-looking and forward-looking view of how the stock is being priced. For example, with Tesla's current percentile at 77%, it may suggest that market expectations and valuations are already elevated. You can then head over to analyst ratings to see what analysts think about the company, along with detailed explanations of their ratings as well as their track record. For deeper analysis, you can check out Morningstar Research. This is a paid feature, but is available for free on the platform. It is one of the main sources I rely on doing investment research. New users who sign up to moomoo SG will get to earn up to $1,315 worth of welcome rewards when you fulfill the terms and conditions, which includes an exclusive $60 worth of Nvidia shares. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. Simply follow the steps below and key in my promo code Kelvin88 to get your exclusive reward. For more details of the promotions, do refer to the link promotion page in the description below. Now, after valuation becomes stretched, the next pattern that almost always appears before a crash is leverage, where investors are using borrowed money to invest. When prices are rising, leverage can amplify your gains, but when prices fall, it can force selling, and that is what often turns normal declines into full-blown crashes. This played a major role in the 1929 crash. In the late 1920s, investors could buy stocks with as little as 10% to 25% of their own money, while borrowing the rest on margin. So when stocks started falling in October 1929, brokers started issuing margin calls, and those investors who could not raise cash were forced to sell. Those sales pushed prices down further, which triggered even more margin calls. In the end, what began as a pullback quickly turned into a collapse. The same thing showed up again during the dot-com bubble. In the late 1990s, margin borrowing surged as investors were chasing fast-rising tech stocks. By the early 2000s, US margin debts had climbed to about $278 billion, which at the time was at record high and roughly 2.6% of GDP. When technology stocks started to fall, leveraged investors were forced to sell into a declining market. This amplified the downturn and eventually led to the Nasdaq's 78% collapse. Then it happened again in 2008. But this time, leverage was not just in stock trading accounts, but spread throughout the entire financial system. Home buyers were taking on mortgages with minimal down payments. Banks were borrowing heavily to buy mortgage-backed securities. Investment banks were operating with extreme leverage. In 2007, firms like Lehman Brothers were running leverage ratios of over 30 to 1, meaning a loss of just 3% could wipe out their entire capital base. When housing prices stopped rising and defaults increased, the value of these leveraged assets collapsed, and forced selling spread through the banks, hedge funds, insurance, and even money markets. Historically, margin debt tends to peak shortly before major market tops. It was elevated before 1929, before 2000, and before 2008. And today, margin debt is again near historical highs. According to FINRA data, total US margin debt has recently exceeded $1.2 trillion, the highest level ever recorded. But more importantly, when adjusted for the size of the economy, margin debt now stands at around 3.8% to 4% of US GDP. For context, typical readings over the past few decades have been closer to 2 to 3% of GDP, while peaks near major market tops tend to occur when this ratio climbs towards the upper end of that range, such as right before the dot-com crash and the 2008 crisis. Now, after valuation becomes stretched and leverage builds up, the next pattern that almost always appears before a crash is excessive speculation. This is when investors stop asking what a business is actually earning and start chasing whatever sector is going up the fastest. In the late 1920s, stock ownership exploded among ordinary households. Newspapers promoted stocks as a guaranteed path to wealth. At that time, many first-time investors borrowed money to participate. Economist Irving Fisher famously declared in 1929 that stock prices had reached a permanently high plateau. Then, of course, we all know what happened after that. The same behavior showed up again during the dot-com bubble. In the late 1990s, investors did not just buy technology stocks, they bought anything connected to the internet. This was despite the fact that back then, more than 80% of companies going public were unprofitable. And yet, demand was so strong that many doubled on their first day of trading. Then again, before 2008, property was no longer seen as a place to live, but as a guaranteed investment. From 2003 to 2006, about 25% of all US home purchases were made by investors and not owner-occupiers. Television shows talk about flipping as a get-rich strategy. At the same time, lending standards dropped. By 2006, subprime mortgages made up about 20% of all new mortgages, up from less than 10% in the late 1990s. Loans requiring little documentation and minimal down payments became common, because everyone believed prices could only go up. And today, the same euphoria is happening all over again. You can see it across many AI-linked infrastructure and future tech sectors, from data center operators and new cloud providers to nuclear energy and data storage companies. In many of these cases, the prices are being driven less by what these businesses are earning today and more by what investors believe they might become. Their valuations are already assuming years of flawless growth, where the story leads and the profits are expected to follow later. Now, of course, just because we see many of the warning signs right now, it does not mean that the market will crash straight away. History often shows that markets can stay expensive and speculative for much longer than people expect. Take for example, in December 1996, the then Federal Reserve Chairman Alan Greenspan famously warned of irrational exuberance. And yes, the market continued rising for more than 3 years before finally collapsing in 2000. Even today, when forward PE ratios are among the highest in history, JP Morgan's guide to the markets show that when valuations are elevated, the 1-year forward returns can still be positive. So the question is, what is still holding this market up right now? The first reason is that many of the companies that are driving the market returns are still producing real revenue and cash flow. For 2026, the S&P 500 earnings are projected to grow by about 15%, while the Magnificent Sevens are expected to grow by roughly 22.7%. That means that the largest contributors to the index are still expanding faster than the markets as a whole. So as long as profits keep rising, high valuations can be sustained for longer than most investors expect. The second reason is the amount of cash still sitting on the sidelines. Today, more than $7 trillion is parked in US money market funds alone. This is the capital that has not been deployed into the stock market. So every time the market pulls back, a part of this cash flows back into equities. This explains why recent declines have been met with buying rather than prolonged selling. Add to that is the policy support. Right now, the market is in a rate cut cycle, which is good for the market as it helps to lift asset prices by lowering discount rates and easing financial conditions. At the same time, deregulation and fiscal spending are injecting demand directly into the economy. Government support for energy, infrastructure, defense, manufacturing, and technology investment is feeding into corporate revenues, especially in the same sectors that have been driving market performance. Put together, this explains why the market has not cracked yet. But at the same time, this does not mean that the risks have disappeared. It simply means that the system is being supported for now. So then, how do you prepare your portfolio so that you are protected if the cycle eventually turns? The first and most important step is to stop using leverage. If you are using margin or borrowing to invest, that is the fastest way to get forced out at the worst possible time. By avoiding leverage, you get to decide when to hold, when to sell, and when to buy, instead of letting the market decide for you. The second step is to keep enough of an emergency fund. While it is important to earn a return from the market, it is just as important to protect your downside. If you have enough cash to cover your living expenses, you will not be forced to sell your investments when markets drop. At the same time, you give yourself the option to buy when prices are cheaper instead of watching opportunities pass you by. The third step is to own businesses that actually make money. In downturns, companies with weak balance sheets, high debts, and no profits are always hit the hardest. So focus on firms with real cash flow, strong finances, and durable demand, as these are the companies that tend to survive market crashes and recover later. The fourth step is to diversify your portfolio, not just across different stock names, but also across different regions. Do not put everything into one country or one market. For example, by adding exposure outside the US to international markets, you will give your portfolio more sources of growth while reducing the risk that one economy or policy shift can damage everything at once. In short, you cannot control when the next downturn comes, but you can control how much risk you take, whether you are forced to sell, and whether you are ready when prices finally go on sale. This is how you survive a market crash, and more importantly, this is how you can come out ahead when the recovery begins. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.